Welcome to the Best Interest Podcast, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and investing in simple terms. Now, here's your host, Jesse Kramer.
Hello, and welcome to episode 76 of the Best Interest Podcast. My name is Jesse Kramer. Today, Jared Dillian is going to be joining the podcast. Jared is a former Wall Street trader at Lehman Brothers. He's the author of 4 books. He writes a newsletter for financial professionals called the Daily Dirtnap. And I've heard Jared speak before, and after talking to him for today's episode, I think Jared, he's almost a bit like a sports radio personality in the way that he's sharp and witty. You know, he's got that kind of fast brain like you'd expect for someone on radio. He's certainly not afraid of controversy. And that's the other thing that kind of makes him like a radio personality. And you'll hear me nicely push back on Jared a couple times today, asking for clarification, asking him to explain further why he thinks things he thinks. And personally, I think it's fun to hear new opinions, to hear different takes. It's fun to talk to those people in general. I enjoy bringing them on the podcast to explain some of their ideas to you all listening. Maybe they'll change our minds, maybe not. But either way, it's just always interesting to know what other people think out there about personal finance and investing. But first, let's get to our review of the week. As a reminder, these reviews are from Apple Podcasts. I really enjoy reading the reviews you guys leave me on Apple Podcasts. You can also leave a rating there, or you can leave a rating on Spotify. Most likely, however you're listening here to the podcast, you can leave some sort of review or rating. This one comes from Long BCH99, who wrote in and said, "One of the best. I listen to several retirement and investing podcasts, and this is one of the best. Jesse does a great job explaining things. He has on interesting guests, and he has an excellent and informative website. I recommend." Well, Long BCH, thank you very much. I appreciate the kind words. And as always, drop me a note, jesse@bestinterest.blog, and I will get you hooked up with some best interest gear. Now, before Jared comes on the podcast today, I want to share with you some of my own thoughts, the usual monologue. And first, because Jared is talking about maybe some unique takes, I thought I would start by reading you from a very recent post I wrote, which was called Boring Money Topics That I Find Fun. One of the first things I thought about when I was writing this article was the way that a lot of kids find some things in life very boring that somehow adults find fun. Now, personally, I didn't even know how to pronounce Les Miserables, the musical, until about 2017. And now, 7 years later, I know all the songs. My wife bought me tickets to Les Mis as a birthday present this year. We're actually going next weekend. And what an amazing musical. 99% of children, I think, they dislike art museums, they dislike musicals, they dislike reading the news. But many adults, we find beauty or intrigue or interest in those same ideas. And a similar boring to not boring transition occurs in personal finance. The problem, or at least the problem as I see it in personal finance, is that the fun of something, of it not being boring anymore, that fun, it doesn't usually last. We had fun getting our personal finances under control. We got hooked on that fun. Some of you listening might be hooked on that fun right now. You might be in the process of improving and optimizing, and you're feeling that fun. And it can last for months or even a few years when money goes from some sort of scary unknown to an exciting area of optimization. But then after we get it all figured out, and that's when, well, as B.B. King famously sang, that's when the thrill is gone. And thus you find yourself here listening to podcasts or reading blogs or something like that, looking for new ideas or just trying to keep the fun there. I don't think that's a reason to despair, though, because the lack of financial fun ultimately is a good thing. It's a sign that your finances are in a great place. But despite my finances being in a very comfortable place, I still find lots of fun financial things to think and learn about. There are a few traditionally boring topics that I still find very exciting. I write about them sometimes, I talk about them sometimes, and here I'm going to share some of them with you, and maybe it'll tickle some intrigue in your brain as well. The first one, getting to know your taxes. I'm not sure it can get more boring than taxes, at least for the layperson, but I actually like taxes. And over the past 2 years especially, I've realized that the tax code is somewhere between a puzzle and a game. And I personally love puzzles and games. The rules of the game are very well defined, although there are a ton of rules. Certainly, I do not know all the rules at this point, but I've learned a lot over the last couple of years. And the more rules I learn about taxes, the better my strategies in that game become. The various pieces, if you will, in the tax code, they interact in different and sometimes surprising ways. And there are always multiple ways to solve a tax problem. Sometimes a solution will decrease this year's taxes. Sometimes a solution will decrease future taxes. Sometimes we trade off lots of effort and paperwork just to save a few bucks. And we have to ask ourselves, is that a worthwhile trade? I mean, this is all kind of game theory, game strategies. Do we want improvements now? Do we want improvements for the long run? And there are many ways to skin a cat, if you will. There are many ways to solve these different tax problems. Now, if you're a young W-2 worker like me, there's not too much to know. Our tax scenarios are fairly simple. I will say for me, the best interest is an LLC. So that adds a little bit of a hiccup in there, which is why I do actually use a tax preparer. I use an enrolled agent to help me file my taxes. But for most young W-2 employees, it's not too complicated. But if you're a retiree and you're earning Social Security income, you're making IRA withdrawals, you're realizing capital gains, hopefully long-term, but maybe some short-term capital gains, or you're doing tax loss harvesting, you're earning interest and dividends. Well, you've got a very interesting tax puzzle lying before you. And the interactions on your simple 1040 tax return can be quite complex and can involve thousands of tax dollars per year. If you're a business owner or you own, say, rental real estate, you own multiple real estate properties, that tax puzzle intensifies. And that's why a good CPA accountant is worth their weight in gold. Now, to be clear, tax planning in this way, or tax optimization, is not about cheating the tax system. When accountants tell me they're aggressive, I take that as a euphemism for, I bend the tax code until it breaks. Now that's bad, and it's usually just straight up illegal. And I recommend you avoid that. I don't think you should be looking to work with an aggressive accountant. And I think that idea of an aggressive accountant isn't a good one. And so if you're an honest accountant listening to this, my recommendation is you find a different word than aggressive. But working with a tax professional who, one, knows the rules of the tax code inside and out, and then two, enjoys optimally solving the puzzle that you bring to them, well, odds are that person can solve your puzzle much better than you can alone. And so at the very least, a pro tip I have for all you guys listening is, starting this year, review your 1040 federal tax return, or whatever your country's equivalent tax return is. Try to go through it line by line. And if you don't understand what a particular line item means, look it up or teach yourself. And over time, you'll understand a little bit more about this interesting puzzle game called taxes. The second boring topic is to wait for a decade or two. Now, many of you know by now that the best interest is a big proponent of long-term investing, which, as you might have noticed, includes the words long-term. We're not talking weeks or months. We measure in decades. We beat a slow tempo drum of basic tenets like buy and hold and diversify. And don't look for needles, just buy the whole haystack. Now, those tips are boring. So to spice things up, I like to remind myself and you of market history. One of my favorite cautionary tales is that returns are never promised, and we have suffered decades of zero returns. I'm going to link an article in the show notes about that idea, that concept, the very real historical concept of decades of zero returns. And there's a chart in that article that is worth looking at that shows 4 unique periods. One to start the 1900s, it was kind of like 1900 to 1921. A second period, which is right around the Great Depression. A third period, which starts in the 60s and goes to the 80s. And then a fourth period that was from the dot-com bubble to the Great Financial Crisis. These 4 periods, which the shortest one was about 14 years long, the longest one was about 20 years long, when there was essentially no return from the S&P 500. If you adjusted the S&P 500 for inflation, and even if you reinvested all your dividends, you could draw a straight line from an early peak to a later valley that was somewhere between 15 and 20 years long with zero return. And now, as I've realized in hindsight, there's a small problem with that idea. Now, everything I just said is factually correct. The chart, if you decide to go look at the chart, is completely factually correct. but it presents data differently than most people think. Inflation adjusting the data is usually a good idea, in my opinion. But when you do that, a chart that is inflation adjusted, it does not measure dollars and cents. Instead, it measures purchasing power. Most of us, though, we measure our accounts in dollars and cents. We understand the reality of inflation, that it's constantly gnawing at our purchasing power, but we don't inflation adjust our conception of the world, right? If $1 grows to $2, we see exactly that. We don't say, oh, but inflation was 14%, so really it's like I only have $1.86. No, we think we have $2. So to fix the problem, I reconstructed that original plot to show nominal dollars. I'll link this article that I'm reading from right now, the Boring Money Topics article, so that you can see this adjusted chart as well. And the adjusted chart looks a little bit different. It looks a little bit more optimistic, but it's still very eye-opening to realize that you can have 4 or 5 or 6 year periods where your stock investment essentially will not grow. It will not grow even if measured in nominal dollars. Imagine someone had started investing, they put $1 million in the stock market sometime in the early 90s. They would have seen their account grow quite a bit between then and now. However, that person could have drawn a straight line from about 1997 to about 2009 with zero growth. And that includes if they reinvest all their dividends. That can be really depressing. If you're sitting there in 2009, you look at your account value, it's 1.6 million. And then you look back in time and you say, oh, I was at 1.6 million 12 years ago. That's not great. That's not what any of us hope will happen to our stock portfolios, but it's a very real possibility. Now, if that person in 2009 with 1.6 million had stayed the course and they held their portfolio till today, 1.6 million, it hasn't quite 10x'd in these past, 12 years, but they are significantly better off today. They're probably somewhere like $12 to $14 million today if they'd stayed the course. But again, the boring idea about investing for decades and decades of time, that idea is boring. But to me, the exciting part is the realization that it's not going to be a smooth ride, right? It's going to be a bit of a roller coaster. And one of the downsides of that is that it's a realistic possibility to think that you might go through a 3 or 5 or even a 10-year period where ostensibly your stock portfolio won't grow one little bit. Now, to me, that's exciting in the same way that base jumping is exciting. It's a far stretch from the lazy shorthand that we often hear, which is, the S&P returns 10% per year. Too many financial influencers use that idea. I've been guilty of that shorthand, and I do understand its usage if we're using it as a shorthand to, for example, calculate 30 years of compounding. 10% a year for 30 years gets you to X. But I despise that shorthand when I hear it used to explain expected stock market returns to a new investor. New investors need to know that stock investing is not a smooth ride. It's not always up and to the right. It involves years, if not decades, of what can feel like wasted time. 5 years is a long time. 10 years, according to my math, is even longer. Now, are you excited to stay the course that long through both the thick and the thin? Of course, the analysis that I'm talking about today assumes a lump sum investment. And of course, dollar cost averaging smooths out that ride immensely. In fact, dollar cost averaging actually takes advantage of the bad times and the volatility. I'm a huge fan of dollar cost averaging, and I invest monthly or even more frequently than monthly in my 401k, my Roth IRA, those kind of things. The third boring topic is to know your flow. That is cash flow. Cash flow is like a cinder block of personal finance. It's boring, it's basic, it's plain, every other synonym thereof. But like cinder blocks, it is also foundational. You cannot build strong personal finances without healthy cash flow. And you won't know if you have healthy cash flow unless you measure it. That is the financial fundamental that most people overlook. And speaking of base jumping, the fourth boring topic that I like to think about is buying protection. Because the exciting part about extreme sports is the jump itself. But it's someone's job to consider the boring questions like, is that parachute packed correctly? Or can that bungee cable support a 300-pound man? Or maybe something like, if he doesn't make it and he lands inside the pit of burning tires, what's our rescue plan? Okay, that's kind of funny, but on a more serious note, What about the modern miracles of, say, CPR and an AED, automated external defibrillator? Christian Eriksen, if you don't know him, he's a Danish soccer player. He's currently on the roster for Manchester United. And on June 12th, 2021, Christian Eriksen, at the age of 29, he had a cardiac arrest during a national team game when Denmark was playing Finland. Now, 50 years ago, he would be dead, straight up dead. But because the training staff is both CPR trained and well equipped with that automated external defibrillator, AED, Eriksen's heart was shocked back to life. It took one shock on the field. You can watch the YouTube videos. It's the kind of thing where if it bothers you to watch someone ostensibly die on camera, it's a little traumatic video. But the fact that he lived means, at least for me, it's very interesting to see. It's kind of like a terrible, but thankfully it ends well, silver lined, you could say, human story, to see people's reactions, to see the fans' reactions, to hear the stadium go silent, but to see this training staff who had asked the right questions beforehand and they were well prepared and well trained, and they react in seconds. They're sprinting on the field, they're checking him, they're doing CPR, they use the AED, and they save his life. Now, in a more American sense, a similar cardiac arrest happened to Damar Hamlin in a Buffalo Bills football game in January of 2023. And again, in that case, an AED was used to shock his heart back to life. Damar Hamlin is alive and well and still playing football. Now, those might be 1 in 10,000 events, right? Low probability. And those are easy odds to ignore. But asking yourself, well, what happens if? That question can lead to some life-saving answers. A little preparation goes a long way. Now, the personal finance world skews less life and death than cardiac arrest, but some of the financial Q&A will point you towards things like a well-funded emergency fund, life insurance, now term life insurance only, guys, home and auto insurance, disability insurance, umbrella insurance. A lot of insurances here, right? Protection is a lot about margin of safety. It's about insurance. But if you're unsure what kind of insurance you do or don't need, ask yourself this fundamental question. The question is, if something bad happened on some particular axis, do I have the assets needed to pay for it? Now, here are some examples. If I died, would my family have the assets and cash flow to continue our desired lifestyle? If your answer is no, you probably need life insurance. If I got disabled and couldn't work, do I have the assets needed for my family to continue our lifestyle? If not, you need disability insurance. If my house burned to the ground or got swept away in a hurricane, something like that, well, you can finish that question. You might need homeowners insurance. If I got sued when the mailman trips on my sidewalk, you might need umbrella insurance. You can ask yourself those kind of questions. If you don't have the assets to cover your potential liability, you need insurance. All right. Now, if everything in your finances feels boring, as we said, that is a good thing. Like Marv in Home Alone 2, you've reached the top.
Harry, I've reached the top.
There are plenty of nuanced topics in personal finance to nosedive into, or you can just go live your life. You can go check out a musical or a museum. And as they say in Les Mis, another story must begin.
Your version is nothing now. Another story must begin.
Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no-strings-attached subscription at bestinterest.blog. But enough of these boring topics. Let's get to some exciting conversation with Jared Dillian. Jared is a writer, an author, a DJ, and a speaker. He's a former Wall Street trader at Lehman Brothers. and has been working in financial adjacent fields ever since. His newsletters include the Daily Dirtnap, a daily market newsletter for investment professionals, and another newsletter called We're Gonna Get Those Bastards, which is about everything that is depraved, especially finance, culture, music, and sex. I haven't read that one, but it sounds intriguing. Jared's books include Street Freak, which we will mention today, All the Evil of This World, Those Bastards, and recently released a book called No Worries, which again, we will dive into a little bit today. So without further ado, here is Jared Dillian. Jared, thanks for sitting down on the Best Interest podcast. Maybe, I think the average Wall Street professional might have heard of you. They know about the Daily Dirtnap, but a lot of the DIYers might not have. So give us a real quick rundown of your career, kind of where you got to where you are, what the Daily Dirtnap is, what you find yourself filling your days with as far as work goes now.
Yeah, I went to the Coast Guard Academy for college and served in the Coast Guard for 9 years. While I was in the Coast Guard, I got super interested in trading. I wanted to be a trader on Wall Street. On my second tour in San Francisco, I went to USF, the University of San Francisco, got my MBA. I also got a part-time job on the floor of the Pecos Options Exchange. So I was a local on the floor for a little while, and then I turned that into a job at Lehman Brothers, started working at Lehman Brothers in 2001. I did index arbitrage for 3 years, and then I ran the ETF desk for 4 years, ETF trading. At the bankruptcy, I decided to leave. Barclays took over the Lehman broker-dealer operation, but I decided to leave and start my newsletter, the Daily Dirtnap. So I've literally been doing that for the last 16 years. I've written a bunch of books along the way. Street Freak was published in 2011. All the Evil of This World was published in 2016. Those Bastards was published last year. And No Worries, How to Live a Stress-Free Financial Life was published in January. I had a very long gig at Bloomberg Opinion. I was an op-ed columnist for Bloomberg for like 5.5 years. Also did that at Forbes. Also had a radio show for a couple of years. So yeah, I've done a lot of stuff.
Cool. Very cool. Now, we're definitely going to talk about No Worries in a little bit. And I think some of the actual specific finance and investing topics that I want to dig into are very much in the vein of No Worries. Some cool stuff that you've talked about recently on your podcast. But going back to Lehman Brothers, I mean, you were there at the bankruptcy, right? You were there during the great financial crisis. Which of your books maybe, or just what can you point people to if they're interested in hearing some of your stories from the inside of what it was like to be there in the trading desk or be there during the bankruptcy?
For sure, you would want to read Street Freak. You can still get it off of Amazon. You can pick up used copies, or you can get it on Kindle. But that's the story of my time at Lehman Brothers from 2001 to 2008, and all kinds of incredible stories which you wouldn't believe. That book is actually pretty old now. I mean, that book is like 13 years old.
Yeah,
and it's held up pretty well over time. I mean, it's a classic.
Can you give us any spoilers, or just like, does any one story stick out from, whether it's in the book or not, but just any one story about how crazy that time was?
I can tell you a story which really, I think, speaks to Lehman's culture. There was an options trader. He traded options on semiconductor companies, and he had a little bit of a temper. I mean, we all did. We all like broke phones and stuff like that. He gets mad, and he takes his phone and he slams it on the desk, and it bounces up and hits his computer screen and breaks his screen, right? So now not only is he losing money, his screen is broken. He can't do anything about it. And he just kind of hangs his head. And within 30 seconds, these two IT guys come over, wearing like burgundy shirts, and they have like drills, and they come up and they go zzz, and they take out his screen and put in a new one like a pit crew. Like it was like NASCAR. They put it, and he was up and running in a minute. And that's really what was so different about Lehman from other firms. Like there was no bureaucracy. Like at a big bank like JP Morgan, you'd have to fill out some forms, some request, and it would have to get approved by like 6 different people. And maybe 3 months later, you would have a new screen. He had one in like 30 seconds. That was Lehman Brothers. And it was kind of an endorsement of his behavior. Like, look, like you're a trader, you're going to get mad, you're going to have emotions. Breaking something every once in a while is not that big of a deal.
It's such an interesting comparison or juxtaposition between those kind of stories or that kind of atmosphere that you were living in, and it is very real in Wall Street, versus the kind of topics or the importance or the stress that people should feel in their everyday finances. So let's dive into some of those topics. I mean, I really liked one of your most recent podcast episodes, the 3 biggest financial decisions you will ever make. What are those decisions, Jared, and why do you place so much importance on them?
First of all, I would just preface this that I would say these are the 3 most important financial decisions that an average person will make, someone of average means. Okay. Mm-hmm. If you have more money, then you're going to have more complex financial decisions. But for the average person, it's buying a house, buying a car, and going to college. Those 3 things are really, if you get them right, will set you on a good path. And if you get them wrong, you will be paying for it for the rest of your life. And honestly, the biggest one is the house. And this is a mistake that people make all the time. Buying a house for a lot of people is an emotional decision. You know, typically what happens is they get pre-approved for this giant loan, which is based on 42% of their income. And they look for houses on that basis, and they find a house that is too big for them, and they fall in love with it. And they're like, yeah, we know the dog can play in the yard and the kids' room is here and the TV goes over here, and they just fall in love with this house. Then they end up overpaying for it, and they have just like all of their free cash flow going out the window to pay for this house, which crowds out their ability to, number one, save for retirement, but number 2, even really to just spend disposable income and enjoy themselves. You know, everything goes to the house. So what I talk about in the book is that decision of whether to buy a house. That's one decision. If you get that decision right, then you don't have to worry about small decisions. And the small decisions are like whether you should buy coffee in the morning. If you get the big decisions right, you don't have to worry about the small decisions.
Yeah. Too many people in this arena place too much emphasis on the small decisions, whether it's the small decisions just in terms of dollars and cents, you know, the morning coffee, or the small decisions in terms of just time spent. I think it was you, but even if it wasn't, I'm sure you would agree with this statement on some level. The idea that you're sitting in the grocery aisle and you're wondering, you know, do I buy the store brand peanut butter or do I splurge for the Jif? Like, it doesn't matter. And why you're spending more than 1 second on it, and, you know, it's a $1 decision. And meanwhile, you've got a mortgage that is 50% too large, and you're stressing about what peanut butter to buy.
People just get jammed up on stuff that does not matter at all. Like, actually, it's funny because I sent out a newsletter yesterday which talked about the whole coffee decision. And I had a guy who I know from Wall Street, and he's been amazingly successful. I mean, we're talking like 9 figures here. He's done really, really well. And he's like, I disagree with you, man. Like, he says, when I lived in New York, like, I always took the subway and I brought coffee to work. And like, what else did he say? I never bought bottled water. And he's like, and that's why I have money. And I'm like, you dummy. Like, that's not why you have money. You have money because like you did all these amazing trades and you created funds, and it was because of your work. It's not because you took the subway. It's not because you saved like $5. Like, it's insane.
Totally. And the other ones on your list, the car and college, a quick little anecdote. Literally yesterday, as we're recording on March 1st, yesterday on February 29th, my wife and I bought a new car. And, you know, the new versus used debate, there's some stuff that I've put out there before that I think some listeners have heard too, that actually the used car market is pretty efficiently priced, and buying a used car isn't really that much of a deal compared to a new car. But we bought a Hyundai, which is very much kind of an economy car. And we did buy new, but my wife's car was 18 years old. She was still driving a 2006 Chevy, right? So we squeezed every mile we could out of that thing. She named the car. It was Sheila. It was really sad to say goodbye to Sheila. But then we bought a new car. We did a lot of research. We bought Consumer Reports, gives Hyundais really good grades. We put a lot of time and effort into it because we know we're buying this depreciating asset. Yeah. And we wanted to make it a smart decision, or as smart as we could.
Yeah, that's the right way to do it.
Now, kind of switching gears, because those are some tips that we said apply to, we'll call it, the broad center of the bell curve, apply to average people. But some people are richer than average. And you put out a podcast recently, and the title of it was, Does It Bother You that Some People Are Richer Than Others? Such an interesting topic. It's something I kind of think about at work because we have some very wealthy clients. We also have some clients who are just starting out and building their long-term wealth. And so I see this. So what was the impetus behind this topic, and what is your opinion on it, Jared?
I don't remember why I talked about this, but I don't experience FOMO. Like if other people are getting rich on something, I'm like, good for them. It's their path. I'm on my path. Like it's like all the Bitcoin stuff from a couple of years ago when people were getting rich off crypto. I'm like, great. Like I'm on my path. I'm going to do my thing. And I don't really care what other people are doing. But a lot of people do. A lot of people are super interested in how much money somebody else is making. And I mean, really, like the word we haven't said yet is envy. Like there's a lot of envy out there. And even Charlie Munger talked about this. Like somebody said to Charlie Munger, like, do you think the world is driven by greed? And he said, no, it's driven by envy. Yeah. And like it took me a long time to understand that because I fortunately was born without that reflex. Like I don't experience envy. I mean, don't get me wrong. There's some people who are richer than me who I think are dumber than me. And, I kind of wish like I had as much money as they had. But like I said, like I'm on my path. Envy is the worst out of the 7 deadly sins because you don't get to have any fun at it. You get to have fun at lust. You get to have fun at sloth, right? But you don't get to have fun at envy. Like envy is just miserable. Not to get political, but envy is what drives really terrible social movements and people get hurt. In some countries, very high tax rates and communism and all that stuff. So, I just encourage people to just focus on what they're doing and ignore what everybody else is doing.
I was hoping you would bring up, I think I've heard Charlie Munger say that same exact thing about envy, right? It's the only one of the 7 deadly sins you don't get to have any fun with. And it is true, right? All it does is drain you. I was having a conversation with a client the other day. It was a terrific conversation just on that topic of, yes, there will always be people in the world, and this might even be a Buffett quote, but there will always be people in the world who are richer than you and also dumber than you. And it's right. It's another version of like, the Joneses down the street, maybe, or like it's frustrating. Maybe some of it's luck. Maybe it's some people are born on third base and others aren't. The world throws you situations that you have no control over. And that brings me back. One of my favorite quotes is an Annie Duke quote. I don't know if you know Annie Duke, Jared, the poker player, right? Annie says, there are 2 things in your life that control the outcome of your life. It's the quality of the decisions that you make and luck. All you can control is the quality of your decisions. Luck is out of your hands. Going back to the original question, does it bother you that some people are richer than others? Maybe at one point in my life when I didn't have as much perspective on the world. But at this point, when you talk about the path that you're on, Jared, and you're on your path and they're on their path, and I'm on my path, and all I can control is the quality of my own decisions.
Yep.
You've been asked about this next topic a lot. It is such an interesting topic, though. I know for a fact that a good number of my listeners are on the FIRE path. They
really?
They are DIYers.
Wow.
They are seeking financial independence. Mr. Money Mustache was an inspiration to them at some point in life. And maybe we do need to separate financial independence from retiring early, right? The FI versus the RE. But let's dive into a little bit on your position on the FIRE movement, at least the way that it's been presented to you. And if you've thought about it before, Jared, I mean, do you think about financial independence differently than the retiring early aspect of it?
First of all, I wrote a Substack about this. I don't know if you saw it. Did you see it?
Yeah, I did. And we will link it in the show notes for everybody to read. Okay. It's a good one.
And some people got upset about that. Number one, I don't want to retire early. And number two, I don't want financial independence. What financial independence means is getting to a number that you have in your head about what makes you independent and then stopping. That's sort of implicit in that. Like you get to a number and then you stop, right? I disagree with that. Like I'm going to go beyond that number and I'm going to keep going and I'm never going to stop. And with regard to retire early, I spoke at Coastal Carolina University a couple days ago, spoke to a class of business students, and I said, I don't want to retire. My goal is not to do nothing. And a lot of people say like, well, you get to retire and pursue your dreams and all that stuff. I'm like, great. Like my dream is to be a DJ, right? Like I'm a DJ already. Like I play parties, but wouldn't it be cool if I just had like 16 hours a day and I could just do music and nothing else? That would actually be hell. Like that would be hell. For my hobby to become my job and like take up my whole life, like that would actually suck. I don't want to retire. I don't want a lot of unstructured free time. Like I like working. And I think the FIRE movement is for people who really dislike their jobs. They don't like working. They want to stop. And then what happens is you stop and then you have $2 million saved up or something like that. And then every time the stock market goes down 3%, you freak out because you think you're going to run out of money and you have to go back to work and you're going to have like a 10-year gap in your resume and you're not going to be able to get a job. That sounds like hell to me. Like it really sounds terrible. So I don't care if the math works out. Like, I mean, the FIRE people say the math works out. And I think their return assumptions on the stock market are a little high. I think if you use 6 or 8% return assumptions, I think it's a different calculus than if you're using 10 or 12% return assumptions. But nonetheless, like I don't want to retire and I'm just going to keep working because I like working.
I like that answer. And we're a big fan here of different points of view. So even though, I mean, I know enough of my listeners well enough that they're going to respect everything you just said, Jared. And I can speak for myself, certainly, where my introduction to the FIRE movement, call it 2015 or so. I'm a 25-year-old engineer, right? Mechanical engineer working in aerospace. I'd give my job a B- or a C+. It simply didn't light my fire. It was paying fine. I didn't mind going into work, but I didn't love it. And yeah, the idea of escaping that particular work style was appealing to me. And I didn't know it per se at the time. I didn't realize it, but I just said, oh, this FIRE movement seems interesting. The idea of saving money, investing for the long run, that I can get on board with that. And so I started learning a lot more. It wasn't until actually I started the Best Interest where I found this passion project. And then that led me to switching careers to where now I'm kind of working one-on-one with clients. I love what I'm doing now. I love my work days. So the idea of the financial side of the financial independence movement, meaning diversify, low-cost index funds, live a frugal lifestyle, I'm on board with all that. Once you find something that you love to do work-wise, I have no need or no desire to retire early. I have no need or desire to hit my FI number and stop. So I totally see both sides of the coin.
You talked about Mr. Money Mustache, and I've never met him. The FIRE movement seems to me to be an anti-consumption movement, really more than anything else. The idea that you would spend money on something that brings you enjoyment is immoral in their framework. You know what I mean? Mr. Money Mustache wrote this whole essay about how he made a pizza at home. He's like, we made the dough and we had the pepperoni and we made this tomato sauce and we made the pizza and it took a couple hours. And he's like, hey, all the ingredients for the pizza cost $5. So I saved $15 instead of buying a pizza for $20. And I'm like, dummy, like you spent 3 hours making the pizza. And if you value your time at $25 an hour, then it's an $80 pizza. You know what I mean? And there's a lot of people out there who like don't understand this relationship between time and money. And for him, it's really more of, he was like, I don't want this like dangerous car rumbling down the street to my house and all this stuff. I'm like, come on, man. Like, it's insanity. The reason Domino's exists is because of a division of labor. We have this thing called a division of labor. Like, Domino's is better at making pizzas than you, and they're faster. So you should buy a pizza from Domino's. And that will take you a minute. And then with the 3 hours that you would have spent making the pizza, do something else, like work, like write short stories, watch baseball, clean the house. Like, it's a better use of your time than making a pizza. I don't know if you ever heard this before, but it's really more of a philosophical issue about capitalism, but it's called the allegory of the sandwich, right?
No.
Okay.
Tell us.
So the allegory of the sandwich is, okay, I don't want to go to the store and I don't want to trade with anyone else. So I'm going to make a sandwich myself. So how long would it take me to make a sandwich? Well, I would have to grow wheat in my backyard and mill the wheat and make flour. And I'd have to raise a pig for the ham and butcher the pig. And I would have to grow lettuce and grow tomatoes and, have chickens for eggs, for mayonnaise and all this stuff. It would take me 1,000 hours to make a sandwich. And that's really the beauty of trade, right? So we have a division of labor. I do what I'm good at, which is like writing newsletters. And I earn money by writing newsletters, which I can use to buy a sandwich, so I don't have to spend 1,000 hours making a sandwich. So the whole thing is just, it's almost anti-capitalist. It really is. And I totally disagree with it.
Oh, well, I definitely think there are corners. Like, I have seen the extremes. There's one website I know of, Jared, where they have a spreadsheet that probably has 200 or 300 line items in it. And every line item is a food. And since you were talking about food there, it breaks the foods down into costs per calorie. If you want to really be frugal here, it's rice and beans and actually some brands of chicken, but it's almost missing a bit of the forest for the trees, in my opinion, and stepping over dollars to pick up pennies. There's definitely an aspect of that in the FIRE movement too that I don't think is healthy. And some leaders in the FIRE movement I've seen are definitely starting to separate themselves from that line of thinking a little bit. I love the allegory of the sandwich. I love bringing it back to kind of basic economics, and trade is a wonderful thing. Currency to promote trade, that's a fantastic thing. Thank God we have dollars and nickels and quarters so that we can trade our bread and ham with one another. I just think it speaks, Jared, to some people worry about the wrong things when it comes to their financial life.
Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you.
Let's talk a little bit about your most recent book, No Worries. What can readers expect from the book?
I mean, it's the best damn personal finance book ever written. It's really, really good.
Humbly speaking.
So the reviews on Amazon today went from 4.9 to 4.8. It dropped to 4.8. So that sucks. But it's gotten great reviews. A lot of people have said it's really changed the way they think about money. I mean, it's about living a stress-free financial life, right? Most of the personal finance books, if you go to Barnes & Noble and you go to the bookshelf, it's a lot of schlocky stuff like 12 ways to become a millionaire and stuff like that. I don't think the goal should be to be a millionaire. Like, that's the goal shouldn't be to get to some number. I mean, the goal should be to be happy with your financial situation. So it's really a book about happiness. And the first part of the book talks about your attitudes towards money. And the first chapter is probably the most important chapter of the book, and it's called You Have to Want It. And a lot of people, they want to want money, but they don't want money, if you know what I mean.
Dive into that a little bit more. They want to want it, but they don't want it. I might need 5 seconds to follow that logic. What is that? What is that?
I would say the vast majority of people don't really have a concept of what it takes to make money. For example, you have a job. You work at a university. You get paid $70,000 a year. Great. So you think you make what you make, unless you get like a cost of living bump or a raise or an award or something like that. But you pretty much make what you make every year. Well, there's a lot of other things you can do to make money. First of all, you could totally change careers, right? You could say, I could make more money selling real estate. So you could leave your career and blow up your identity and become somebody totally different and get a different job and start making more money. It's very hard to do, but some people do that. You could start doing passive income. You could start buying out houses and renting them out. A lot of people do that. People become millionaires doing that. You could start a business, like even a small business, even like selling tchotchkes on Etsy or something like that. That's a business. You can make 10 or 20,000 more a year doing that. There's lots of things that you can do to make more money, but you have to want it. You have to want it. And it takes work and it takes effort. I mean, look, like I'm guilty of it too. There's things I could be doing to make more money, and I choose not to do them because I'm happy with my present situation. I'm complacent, and a lot of people get complacent. But if you're not complacent and you're hungry, there's a lot of things you can do to make more money.
Got it. You have to want to do that thing that's going to lead to more income. Yeah, I can understand that. And I can also understand, again, having seen both sides of the coin a little bit. In my old career, it was here's your salary and here's your 2 to 3% cost of living raise. I'm not sure I started this side project in the pursuit of money per se, but it definitely opened my eyes to other avenues out there. What are some other ways, Jared, just some other stresses, some other worries that you see out there in the, whether it's in like the personal finance content space that you think aren't merited, or just from average people who you've interacted with where they're worrying about something that you just think isn't worthwhile?
Well, the two sources, and there's only two sources of financial stress. The two sources of financial stress are debt and risk, and that's it. So if you have a lot of debt, it's going to cause you stress. If you have a lot of risk in the financial markets, it's going to cause you stress. Pretty much nothing else. I address this in the book, but some people say, well, if you don't have enough money, then you're experiencing stress. And I actually disagree with that. As long as your basic needs are met, okay? If your basic needs are met, if you don't have debt and you don't have risk, you're perfectly happy. I know lots of people who don't have much money. They're debt-free. They're not investing, and they have nothing to worry about financially. They're perfectly happy. Then you have the richest guy in the world, Elon Musk, who almost went bankrupt when he took out a loan to buy Twitter and pledged his Tesla stock as collateral, and the stock went down 75%. The richest guy in the world almost went bankrupt. He has financial stress. So it's all about how you structure your life. It's not a function of how much money you make at all. So the two sources of stress are debt and risk. And if you minimize your debt and risk, you're going to be okay.
So I definitely get on board with minimizing the debt. I mean, a lot of people in the personal finance space have heard that idea before. Minimizing risk, though, I mean, how does one invest for the future, save for retirement, those kind of things? I mean, minimizing risk, are you saying like take risk all the way to zero, or is there some in-between number, if you will, that makes more sense?
Yeah, so in the book, I talk about something called the awesome portfolio, okay? And you mentioned low-cost index funds before. And sort of the conventional wisdom these days is that how you should invest for retirement is you should put all your money in the S&P 500 and dollar cost average it and ride out the volatility, and you'll have a big number at the end. Or maybe a more conservative version of that is you have 60% in a total stock market index fund and 40% in a total bond market index fund, and you dollar cost average that and you have a big number at the end, right? So the problem with that is that when you invest in an index, you get the returns of the index, which are good, but you also get the volatility of the index, which is undesirable. And the S&P 500, it moves around 15 to 20% a year, which is a huge amount of volatility. So over the course of a 40 or 50-year investing career, you're going to have 20 or 25, 10% corrections. You're going to have 5 to 8, 20% bear markets. And one time or more, you're going to have a 50% drawdown. And Vanguard has marketing around this. They, in their ads, they say just ride it out, just hold on. They're like the Bitcoin guys. They're telling you to hodl, right? Like they just hold on. All right. Let's say you had the ability to hold on, and let's say you don't panic and sell at the bottom, which is what a lot of people do. But let's say you had the ability to hold on. You're going to be miserable. You're going to be absolutely miserable, like riding out all this volatility in the stock market. And the solution to that is something called the awesome portfolio, which is 20% stocks, 20% bonds, 20% gold, 20% cash, and 20% real estate. Okay. This portfolio returns about 1% less than the S&P 500 with half the volatility of an 80-20 portfolio. You're trading away 1% in terms of gains, but you're cutting your volatility in half. And also drawdowns matter, right? The max drawdown you experience in any given year. So in 2008, the stock market was down like 38%. The worst drawdown for the awesome portfolio in any year was 12%, which was actually in 2022. That's the worst year you can possibly have, is you're down 12%.
Out of curiosity, if someone wanted to dig into that, I'm sure you share some of the details in the book. But when it comes to specifically the gold and the real estate portions of that portfolio, some sort of diversified index, or gold, the GLD ETF maybe.
Yep.
And then for the real estate specifically, I could say, oh, my house. But is that too concentrated, or is there some more diversified way to invest in real estate?
So the way I leave it up to people, I'm like, you can use the equity in your house as the real estate portion, and you should do that. But you can also buy a REIT index, right? So VNQ, which is the Vanguard REIT index, that accomplishes the exact same thing. And by the way, a lot of people don't know this, but since the year 2000, out of those asset classes, gold has been the number one performer since the year 2000. And real estate has been number two. Stocks have actually been number three since 2000. A lot of people say only 20% stocks. You only have 20% of your money in stocks. We have a cult of stocks in this country. Like, we are the only country that does this. There's no other country in the world that invests in their stock market for retirement, right? Nobody else does this. We're the only people that, and it's insanity. You know, we are a country of crazy gamblers.
We love our businesses, Jared. We love our businesses. Well, this has been awesome. This has been fun and funny and enlightening and really cool. Some cool, unique topics I think we've covered today, Jared. So let's go over some of the important stuff now. If folks want to, they want to check out the book. Maybe they want to check out the Daily Dirtnap. They want to listen to you on the Be Smart podcast. Where can you point our listeners to find you and check out your stuff?
The book you can get, we have a link. It's called buynoworries.com. So if you go to buynoworries.com, there's a whole bunch of retailers there. You can find me and the podcast at jareddillianmoney.com. That's jareddillianmoney.com.
Fantastic. All of that will be in the show notes. And Jared Dillian, thanks for stopping by the Best Interest Podcast.
Thank you.
Thanks for tuning in to this episode of the Best Interest Podcast. If you have a question for Jesse to answer on a future episode, send him an email at jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves, and we really appreciate it. We'll catch you on the next episode of the Best Interest Podcast. The Best Interest Podcast is a personal podcast meant for education and entertainment. It should not be taken as financial advice and is not prescriptive of your financial situation.